Hi there, Julianne coming to you today from a beautiful part of the world in Northern Ireland called Newcastle. And this weekend, this lovely bank holiday weekend, there's some kind of golf open fringe festival. For all you golfers out there would understand better than me. But anyway, it's a lovely weekend and there's a lot of nice atmosphere here. Anyway, but it's a good place for me to talk to you about the topic I'm going to talk to you about today. You see, this is where I have a lot of my clients, and if you're not aware already, what I do is financial education. I teach families about financial matters and how to actually understand their finances, as opposed to being steered or waylaid by the financial institutions. So basically, in a nutshell, I empower them to make their own decisions as opposed to sell to them or advise them. Okay, so the thing about this part of the world, there's a guy up here, he's a financial advisor, and in fact he's not a financial advisor anymore because I have had him single-handedly struck off the Financial Conduct Authority because of malpractices, to say the least. So basically the reason I have a lot of clients up here is because I've done a lot of fixing and patching up a lot of wrongdoings that he did, and it has been very rewarding, to say the least. But the one wee tip I'm going to give you today is about life insurance and illness insurance. Now, most people, when I mention that, they sort of run a mile or recoil in horror, and rightly so, because the financial industry hasn't really, put themselves in a good light in that area, really, because they've done an awful lot of pulling the wool over people's eyes. But most people I come across, they don't know how much life insurance they've got, they don't know how much they're paying. Well, they might know how much they're paying, but they don't know how much they've got, and they don't know if it's likely to pay out. So basically what I do is I help them get the best quality insurance, that's right for them and their family. So the first thing we got to do is find out, well, how much cover have they got? Is it too much or too little or just right? What they got to first of all work out is what they want paid out if, in the event of the worst happening. And most people tend to want a lump sum paid towards their mortgage and their debts and their funeral, and maybe a lump sum to the kids. So working that out for them is something I do. And then we work out a good price, one that's reasonable, that will give them the right amount to cover. And then what we got to do is look at, well, is it going to pay out? So when it comes to looking at is it going to pay out, there are three sort of areas to look at. And the first thing in terms of life insurance is looking at whether it's a joint policy or a single policy. Now, the thing about joint policies is they're very, very expensive. You see, you're paying double the amount of money for one payout, where you can get two single policies for a similar price. Now, it's a no-brainer to me to give a client, two policies as opposed to one joint one, because the price is probably in and around the same price. Then there is, you got to look at, is the policy term decreasing in value? The policy cover decreasing in value, or is it a level term policy? Now, if it's decreasing, that means that the value is going to go down in line with the mortgage. So if you die towards the start of the policy, you're going to get quite a high payout. If you die towards the end of the policy, you're going to get quite a low payout. Now, the insurance companies know that most people, statistically, are going to die towards the end of their policy if they do die in that term. And therefore, what's going to happen? They're going to pay out the least. So they get the most amount of money out of you throughout the whole policy, and they pay out the least. So would you be surprised to hear that a level term policy as opposed to a decreasing policy is a similar price? So this is another thing I set up for families, is I get them level term policies as opposed to decreasing for similar price. Again, an absolute no-brainer. But the life insurance companies love to sell you the decreasing one because they get more money. Anyway, and another thing you got to look at, and it's more in terms of illness. Now, most people are sold critical illness insurance policies. Now, a critical illness insurance policy does what it says in the tin. It pays out for the most critical version of the illness. And even then, they'll look at every which way not to pay out. For example, you've got to lose both legs in the same incident for it to get a payout. If you lose one leg, it's not going to pay out. And as for cancer, you've got to get the right type of cancer or the right type of aggressive cancer in order for it to pay out. So many people get turned down because they don't have the right amount of cancer or the right level. So there are other policies out there. There's one that's called a serious illness cover policy, and what it does is it pays out for more minor illnesses or more medium versions of an illness. For example, if you get a less aggressive cancer and it's not quite critical, it will pay out. If you get a heart attack that's not quite critical and it's more of a medium type heart attack, it still takes you out of work and you're not getting paid, it will pay out. So with modern medicine these days, where more and more people are surviving illnesses, we think that makes a lot more sense, don't you? So when it comes to looking at sort of life insurance and illness cover, you got to look at is it decreasing or level? Choose level every time. If it is joint or single, choose single every time. And when it comes to illness, critical illness or serious illness, choose serious illness every time, because it is more likely to give you a payout. Okay, if anybody has any queries or questions, just get in touch. Thank you. Bye bye.